Is this token a life-changing discount or are you catching a falling knife? Look at your screens right now. The charts are screaming red, the moving averages are crossing into death territory, and the retail forums are flooded with panic. Yet, right under the surface, a group of quiet accumulators are calling this the buy of the year. Welcome back, everyone. Today, we are breaking down two massive assets that are completely dividing the market: Shiba Inu, the community driven heavyweight known as SHIB, and Near Protocol, the high performance layer 1 ecosystem known as Near. Both of these assets are flashing conflicting signals. On one side, we have technical indicators screaming sell. On the other side, we have fundamental updates that suggest a massive coil spring. Before we dive deep into the charts, take a second to hit that like button, subscribe to the channel, and turn on notifications. Compulsory assignment for today: leave a comment below with your current position. Are you holding SHIB? Are you accumulating near? Or have you completely moved to stable coins? Let me know and let's debate it in the comments. Let's start with the asset overview to understand why these two are capturing the entire market's attention right now. Shiba Inu started its life as a meme, but it has evolved into something much larger. It is no longer just a token, it is an entire ecosystem attempting to build a decentralized network. With its layer 2 scaling solution, Shibarium, the project is trying to transition from a speculative asset to a functional utility network. The reason it is in focus today is simple: the burn rate is spiking, utility is expanding, but the price action is refusing to follow the fundamentals. It is stuck in a brutal consolidation pattern that has retail traders losing patience. Then we look at Near Protocol. Near is an entirely different beast. It is a highly scalable, sharded blockchain designed to provide a user friendly platform for decentralized applications. Near utilizes a unique scaling mechanism called Nightshade, which allows it to process massive transaction volumes without clogging the network. Why is Near in focus today? Because it sits at the absolute intersection of Web3 blockchain infrastructure and artificial intelligence. Yet, despite massive ecosystem partnerships and rising developer activity, the token price has been hammered by macro liquidity drains. Let's pull up the charts and jump into the technical analysis. If you look at the daily and weekly charts for SHIB, the trend direction is undeniably bearish in the short term. We have seen a consistent series of lower highs and lower lows. SHIB is currently battling to hold on to a critical multi-month support level. If this level snaps, we are looking at a straight drop down to the next liquidity pocket, which could wipe out another significant percentage of its value. The momentum indicators like the relative strength index are hovering just above oversold territory. But being oversold does not mean an automatic bounce. It means the sellers are in complete control. The key resistance sits heavily at the 50-day moving average. Until SHIB can reclaim that line on a daily close with high trading volume, any upward move is just a relief rally designed to trap late buyers. Now flip over to the Near protocol chart. Near's technical structure shows intense short-term weakness, but with a structural twist. The token has retraced a massive portion of its previous impulse move. It is currently retesting a historical demand zone where institutions previously stepped in to buy. However, the moving average convergence divergence indicator is still printing bearish histograms. Resistance is stacked thick above the current price, specifically around the psychological whole number levels. The volume profile shows that buyers are stepping in defensively, but they lack the aggressive momentum needed to reverse the macro downtrend. The short term strength is non existent, and the charts suggest we might see one final liquidation flush before any real structural bottom can form. When you look at institutional ratings and algorithmic signals, the data paints a bleak picture. Most automated trend following models have logged in strong sell or hold ratings for both assets. The negative signals are piling up. Exchange inflows for SHIB have shown sudden spikes, which usually means whales are moving tokens out of cold storage and onto platforms to prepare for potential selling. For Near, the derivatives market shows a major surge in short open interest. Traders are actively betting that the price will continue to slide lower. The short term outlook, according to these algorithmic indicators, remains heavily skewed to the downside. The sentiment models are sitting firmly in the fear zone, and historical data tells us that assets can stay irrational and suppressed longer than retail traders can stay solvent. This brings us to the ultimate debate dominating every trading desk right now. Are SHIB and NEAR fundamentally undervalued, or are they classic value traps? Let's look at the undervalued argument first. Proponents argue that SHIB's current valuation completely discounts the development of Shibarium, the growing ecosystem of decentralized applications, and the constant token burns that reduce circulating supply over time. For Near, the undervalued thesis is even stronger based on technology. How can a blockchain that solves the blockchain trilemma, scales infinitely, and integrates deeply with AI technology be trading at such a steep discount from its all time highs? The bulls argue that this is a textbook mispricing caused by market wide liquidations and macro fears. But now look at the counter argument, the value trap thesis. A value trap is an asset that looks cheap on paper, but it keeps getting cheaper because the underlying demand is fundamentally dying. Critics argue that SHIB's massive supply makes a sustained upward move nearly impossible without trillions of tokens being instantly erased. They argue that meme coin liquidity has fragmented into thousands of newer tokens, leaving SHIB out of style. For Near, the value trap argument centers on user acquisition. No matter how superior the technology is, if the broader public does not adopt the decentralized web, the network utility drops, and the token becomes an over engineered asset with no real fee generation. If you buy here thinking it's a bargain, you might just be funding the exit liquidity for larger funds. The downside risks here are real, and the volatility is brutal. This is exactly why retail traders consistently get trapped in these market cycles. Retail investors tend to buy based on psychological bias. They see an asset down 80% from its peak and think it cannot possibly go any lower. But mathematically, an asset that is down 80% can still drop another 90% from that specific point. The volatility in SHIB is driven by crowd sentiment. A single whale wallet moving funds can trigger a cascade of panic selling among retail holders who bought at the top. With Near, the risk lies in broader market liquidity. When global markets tighten, speculative technology assets are the very first things that hedge funds liquidate to cover their liabilities elsewhere. Retail traders get trapped because they look at the local charts while ignoring the global macro environment that actually pulls the strings. Let's break this down into a clear bull case versus bear case scenario for both assets. The bull case for Shiba Inu relies entirely on a massive resurgence of retail mania combined with a supply shock. If the Shibarium network suddenly lands a massive global partnership that drives transaction utility through the roof, token burns will accelerate exponentially. In a best case recovery scenario, Bitcoin stabilizes, liquidity rushes back into large cap alternative assets, and SHIB breaks past its 50-day and 200-day moving averages, triggering an aggressive short squeeze that clears out the bears and targets the yearly highs. The bear case for SHIB is a slow, painful grind lower. If retail interest continues to drift away toward newer chains, the trading volume will dry up. Without volume, the sell pressure from early investors taking profits will easily overwhelm the remaining buyers. The worst case continuation scenario sees SHIB breaking its ultimate floor of support, turning previous demand into permanent overhead resistance, and bleeding value against Bitcoin until it becomes irrelevant. For Near Protocol, the bull case is tied to the narrative of technological dominance. If the decentralized AI sector experiences a massive capital rotation, Near stands out as a prime infrastructure play. In the best case recovery, developers flood back to build on the network. Transaction fees generate real yield, and strategic institutional partnerships drive massive capital inflows. Technically, this would look like a sharp V shaped recovery of the historical demand zone, reclaiming key structural levels and transforming Near into an outperforming asset. The bear case for Near is driven by infrastructure stagnation and fierce competition. The layer 1 landscape is incredibly crowded. If rival networks capture the majority of developers and liquidity, Near risks becoming a ghost chain despite its brilliant technology. The worst case continuation lower involves a macro market rejection where Near loses its historical demand zone, forcing institutional funds to cut their losses and sell their allocations open market, driving the price down into a multi year accumulation trough. Looking at the outlook, we have to separate the short term noise from the long term perspective. In the short term, the path of least resistance for both SHIB and NEAR appears to be a continued battle against macro headwinds. The technical weakness, negative signals, and prevailing market fear suggest that patience is required. Expect heavy volatility, sudden fake out rallies that look like reversals but turn into traps, and ongoing retests of major support lines. Long term, however, the landscape changes. The digital asset market rewards survival. If SHIB can successfully transform its identity from a speculative meme into a legitimate decentralized ecosystem with real economic activity, its long term viability increases dramatically. If Near Protocol proves to be the indispensable foundational layer for the next generation of Web3 and AI applications, its current price levels will look like an absolute anomaly in hindsight. But here is the reality: the market does not care about our timelines, our theories, or our hopes. The charts show a clear short term downtrend, the analysts are shouting warnings, and the order books are highly unpredictable. Yet the underlying technology continues to develop and the communities continue to hold the line. This brings us to the ultimate question that every single person watching this video needs to answer before making their next move. Is this current price drop the ultimate market shakeout designed to transfer wealth from the impatient to the patient? Or are we witnessing a fundamental shift where these previous market favorites slowly fade away into the next crypto winter? Are you looking at the ultimate buying opportunity of the cycle, or are you staring directly into a value trap that will take years to recover? Think about it. Look at the data and make your play. Don't forget to like, subscribe, and drop your exact thoughts in the comments below. See you in the next one.